Today we are talking about IUL, specifically how your cash value grows. If you've heard about IUL, you might know some basics such as there's a 0% floor to protect you against losses and probably a cap on potential gains. But if you look into your policy, you'll notice that there are different account options available for growing your cash value. So in this video, I'm going to break it all down for you, how each option works and what to consider when you're allocating your money. As a consumer, I think you need to understand how all these work. So typically you will make premium payments into your policy. When the insurance company receives your payments, they will first cover the policy expenses. Then whatever is left over is added to your cash value. Within an IUL, we have a fixed account and an indexed account. So you can allocate your cash value to either a fixed account, an indexed account, or a combination of both. For example, you might choose to split it 50-50 between the two, or whatever way you prefer. Fixed accounts and indexed accounts are very different. So let's see how each account works. With a fixed account, the insurance company sets the interest rate each year. So you will know how much credit you will get at the end of the year in advance. For example, if you allocate $10,000 in cash value to the fixed account and the interest rate is 5%, you know you will earn $500 by the end of the year. That's 5% of the $10,000. It's simple and straightforward. Now the index account is where things get interesting. The growth here is tied to the performance of a market index like S&P 500. Most IUL policies will have multiple indices you can select from. The better the index you choose performs, the more your cash value can grow. Within the indexed account, there are different strategies that determine how interest is credited to your account. So let's look at them. The most common option you will encounter is the cap strategy. A cap is the maximum interest credit your policy can earn in a specific period, usually annually. For example, let's say the cap is 10%. If the market grows by 8%, you're going to get an 8% credit because it is within the range of 0 to 10%. Now, here's what you have to understand. If the market grows by 12%, you can't go above the cap, so you will get a 10% credit. On the other hand, if the market crashes and we have, say, negative 6%, that's where the floor really becomes a hero. You get 0% credit, so you don't lose any money due to what happened in the market. You will remain at the same level as you were before the market dropped. Another important thing to note is that all the previous gains are locked in and protected from future market losses. So if your account grows from $10,000 to $13,000 and the market crashes, $13,000 become your new floor. You won't lose those gains. When the market recovers, you will start compounding from $13,000, not $10,000. The cap strategy is going to be the most common strategy you run across in most IUL products. The next option is the participation rate strategy. The participation rate determines what percent of the market return you get to enjoy or participate in. Do you get to keep 50% of the market returns, 100%, or even 200% of the market returns? That's what this strategy is about. For example, you might come across an uncapped option with a 200% participation rate and a 0% floor. That's a mouthful, isn't it? What this means is that there is no cap or limit on your growth like the previous strategy. And whatever the index grows by is multiplied by 200%. So if the market grows by 6%, you get a 12% credit because 6% multiplied by 200% equals 12%. If the market grows by 7%, you will get a 14% credit. However, if the market crashes, the 0% floor still protects you from losses. Now, not all participation rate are 200%. You might come across a 50% participation rate, meaning you would only get half of the market's performance. For example, if the market grows by 6%, you get a 3% credit. If it grows by 10%, you get a 5% credit. And if it grows by 15%, you get a 7.5% credit. Again, the 0% floor protects you from losses in the market. The last strategy, which is less common, but you might see in some IUL products, is the spread strategy. In this strategy, there is no cap, but the insurance company takes a percentage off the top. Let's say 6%. So if the market grows by 10%, the insurance company keeps the first 6% and you get the remaining 4%. If the market grows by 15%, you will get 9% credit after the 6% spread. And if the market grows by 26%, you get a 20% credit after the spread. However, if the market only grows by 6%, you won't get any growth because the insurance company keeps the first 6%. And as always, the 0% floor protects you from losses in the markets. Now that you understand how account is credited, let's cover some important points to keep in mind when dealing with index strategies. Rates in IUL policies are not fixed. They can change based on interest rates, market performance, and volatility. Always make sure you're looking at the most current rates, whether you are getting a new policy or reviewing an existing policy. Sometimes the three main strategies, cap, participation rate, and spread, can be combined. For example, you might see 100% participation rate with a 12% cap. Don't let this confuse you. Do the math as we've done before, knowing that the cap will always limit how much can be credited to your account, regardless of the participation rate. Remember, the cap determines the maximum credit you can receive. You don't have to put all your money in one index. Just like they say, don't put all your eggs in one basket, isn't it? You can diversify your allocations across different market indices, which can be a smart way to manage risk and sort of get some growth within your IUL policy each year. No one has a crystal ball to predict which index will perform the best, so you can spread out your money across a few indices so that at least you have a chance of getting some growth each year. Your initial allocation is not set in stone. You can adjust your allocations based on market conditions, volatility, and actual performance of the index. It's a flexible process. You just need to know when those changes will actually take effect. For some insurance companies, even though you can change your allocations at any time, it might not go into effect until your policy's anniversary date. I hope these points give you a clear understanding of how to manage your IUL policy. If you found this video helpful, please give it a thumbs up, leave a comment, and share it so others can benefit. I'm Gilbert, and I'll see you in the next video. Bye.